Welcome back to the Deep Dive. Today we're taking a really fascinating look, into one of the most uh, dynamic real estate markets in the Asia Pacific.
Has to be Hong Kong.
Has to be Hong Kong.
Yeah.
Specifically, the long-term rental and business accommodation landscape.
Yeah.
I mean, for years this market's been all about high prices, tight supply. But, well, recent shifts have created this really volatile, high-stakes environment.
Yeah.
So our mission for this deep dive is to give you that shortcut. We want to get you right up to speed on what seems to be the biggest disruptor in the space right now, Weave Living. We're unpacking the sources on their really aggressive expansion.
And that volatility you mentioned is so important here. If you look at the underlying market, Hong Kong's whole extended stay and flexible living sector is it's growing so fast.
Right.
It's partly because of these available distressed assets, especially from the hotel sector after the pandemic. And at the same time, demand for quality long-term housing is spiking. It's kind of a perfect storm for a company that has capital ready to go.
Okay, so let's unpack that shift right there. Because Weave Living, I mean, historically, they were all about co-living.
Almost exclusively.
Yeah, focused on young professionals, students, people who wanted flexibility and community, maybe over raw space. But the sources we're looking at show a fundamental change, a total evolution of their business model.
It's a pivot, a big one.
They are diversifying way beyond those co-living routes. They're moving aggressively into dedicated service departments, and this is the big one, into traditional multifamily residential. It seems like they're trying to capture the whole spectrum.
Exactly. And the core takeaway from the material is that this isn't, slow internal growth.
No.
This is driven by strategic, capital-heavy property acquisitions and the rapid conversion of existing buildings. We're seeing huge deals for prime apartment complexes and, crucially, serious talks about turning hotels into long-stay accommodation.
A massive bet.
A massive bet that the future of Hong Kong real estate is in these institutional, professionally managed long-term rentals.
Okay, let's dive right into that diversification, because it really defines their whole strategy. They're not just tweaking things. They're building out three distinct pillars.
That's a good way to put it. Pillar 1 is their original co-living model. Community events, efficient spaces. That's still there.
Okay.
Then Pillar 2 is serviced apartments. This is absolutely vital for the corporate relocation and business traveler market.
Right, the extended stay crowd.
Exactly. Full amenities, cleaning services, all of it. And then Pillar 3, that's the traditional multifamily rental. Unfurnished or semi-furnished, longer leases, perfect for families or, established professionals.
And the rationale for doing this, for structuring the business this way, it seems incredibly smart. Because with these three tiers, they're basically building a customer pipeline.
Think of it like a ladder. That's exactly it. This diversification lets Weave capture a renter at pretty much every stage of their life in Hong Kong.
So you get them when they're young.
You catch the newly arrived young professional in co-living, then maybe they get a corporate contract, you move them into a service department, eventually they want to settle down, and you offer them a multifamily unit. That stability is so appealing to investors. It ensures you have high occupancy across the whole portfolio.
And that focus on the high end, the corporate, the extended stay market,
Yeah.
that's where the most stable revenue is, right?
Yeah.
It's not as vulnerable to, say, swings in tourism or student numbers.
It's a clear move toward institutional tenancy, and we have a perfect case study for this pivot away from their roots. They bought a property at 6 to 8 Hospital Road in mid-levels.
A very desirable area.
Highly sought after. And what did they do? They fully refitted it to become the company's very first traditional dedicated rental apartment property.
That location. That's not a coincidence. Mid-levels is a classic blue-chip residential spot. To convert a property there signals that they're serious about competing with the big established landlords who have owned that space for decades.
Right. They're not just a niche co-living brand anymore. They're going head to head.
And that conversion process itself must be complicated. You're taking an old residential block and bringing it up to an institutional grade.
Oh, absolutely. You're talking about significant capital expenditure, CapEx. You're upgrading security, modernizing the common areas, making sure every single unit meets a consistent high standard. It shows a huge commitment of capital that goes way beyond just the purchase price.
Okay, so let's move from the strategy to the execution, because this is where you see the sheer scale of what they're doing.
Yeah.
And I know this one acquisition was just monumental.
Mm-hmm.
Here's where it gets really interesting. We have to talk about the purchase of the Largos residences.
Ah, yes, the Largos residences. At 123 Queens Road West in Sheungwan, This is a massive piece of the puzzle. It really solidifies their move into that premium serviced apartment space.
And Sheung-Wan is a core business district, a
Yeah,
trophy asset, like you said.
totally.
So give us the hard numbers on this, because they really tell a story about confidence in Hong Kong's premium market.
Okay, so the purchase was for a 23-story serviced apartment complex. It has 44 units, and it was reportedly acquired for HK $585 million.
Wow.
If you do the math on a per-unit basis, that says a lot about current valuations and Weave Living's willingness to pay a premium for existing high-quality inventory in a prime spot. This isn't them bargain hunting. This is targeted high-value growth.
Putting over $500 million Hong Kong dollars into one asset. I mean, that's not just a bet on long-stay rentals. That's a specific bet on the upscale, highly profitable corporate market.
Absolutely. But that high price tag immediately brings up the question of risk.
Sure.
The property is prime, no doubt, but maintaining a high-end service apartment building requires constant capex, big operational staff. They're taking on the risk of, fluctuating occupancy and high overhead to get that premium rent. It's a very calculated gamble.
So if the Largos deal is about targeted premium growth, then the hotel conversion strategy is about just massive, rapid scale. The sources outline this really aggressive tactic. Weave Living is actively in discussions to buy 2 specific hotels in Kowloon.
Yeah. They're planning to fundamentally change hospitality assets buildings designed for short-term tourists into huge, long-stay rental hubs.
This is their high-volume play, and it's a brilliant move, frankly. They're capitalizing directly on all these hospitality assets that have been struggling since 2019. The 2 hotels named in the sources are Hotel Kuzi Harborview and Hotel Ease Mung Kok.
And the impact, if they pull this off, if they actually convert both of those properties, we're talking about an unprecedented amount of new housing coming online very, very quickly.
The scale is transformative. It's a total game changer. If those 2 deals go through and they do the conversions, they would add nearly 800 rooms to their portfolio, almost overnight.
800.
Just think about the logistics of building 800 new apartments from scratch. This strategy lets them bypass years of planning, of construction. They're repurposing these huge existing structures that already have kitchens, bathrooms, utilities in place, and turning them into modern residential units. This is the defining feature of their scaling strategy. This would effectively move them from being just another competitor to, potentially a dominant force in institutional rentals across Hong Kong, just by using capital to skip the entire traditional development pipeline. All right, we've covered the acquisitions, the strategy. Let's connect this to the bigger picture in our final segment, the market context, and who's backing all this.
Yeah, so if you connect us to the broader picture, Weave Living's expansion really reflects a global trend. You're seeing private capital shift toward what's called operational real estate, meaning assets that generate income from fees and rent, not just from the property value going up. It confirms this revival of investor interest in flexible housing all across Asia.
And this isn't small-time money. The sources are very clear that Weave Living is backed by Warburg Pincus, a major private equity player.
Right. And that name signals massive investor confidence in this whole strategy.
The diversification, the high-value acquisitions, all of it.
The involvement of a PE giant like Warburg Pincus is key. They aren't just buying buildings, they want to create an institutional platform, a repeatable, scalable business model built on steady rental income. In a city like Hong Kong, where commercial real estate can be so volatile, stable rental income is, it's extremely attractive to these big funds right now.
They're buying predictability in a chaotic market.
Exactly. And that predictability is reinforced by their very clear locational strategy. The sources stress this. They aren't just buying any distressed asset they can find.
No, they're very selective.
Very. They're focused on specific criteria. Locations near MTR stations, near key transport infrastructure.
Makes sense. Accessibility is everything for their target customer. The mobile professional, the corporate team.
It's non-negotiable. By putting their properties near transport hubs, they maximize their appeal and they minimize the risk of vacancies. It's an efficiency play, really, and it's a strategy that they can easily replicate in the other big Asian cities where they operate.
So what does all this mean for you, for the person trying to understand the Asia-Pacific real estate market?
I think the combined strategy here, the targeted acquisitions, the huge hotel conversions, and this portfolio that captures renters at every stage, It shows a really comprehensive plan to dominate the entire rental segment.
Right.
They're not just a niche co-living provider anymore. They're positioning themselves to be the institutional landlord of the future for any kind of long-stay solution.
They're basically building a scalable system, one designed to manage risk, attract that deep institutional investment, and grab market share from both traditional landlords and the struggling hotel sector all at the same time. It's really sophisticated, high-stakes disruption. That brings us to our final takeaway. We've gone deep into the sources on Weave Living today, and three things really stand out. First, that strategic diversification into traditional apartments and serviced apartments. It's a total transformation.
From niche to full spectrum.
Second, the major high-value acquisitions, like the Largos residences. And third, that aggressive, massive push to convert hotels. I mean, those two Kowloon hotels alone could bring almost 800 new units online.
And that last point, the hotel conversions, is maybe the most important trend happening right now. It raises a really interesting question for you to think about.
What's that?
As these global property companies use huge amounts of capital to rapidly convert commercial spaces, especially hotels, into flexible long-term housing, how might this fundamentally change the balance of power between traditional hospitality providers and the big corporate rental providers in Asia's most expensive cities? The capital is clearly picking a side between short-term stays and long-term residency.
A fascinating thought about the future of urban space in Asia. That's it for this deep dive. We'll see you next time.